All right, welcome to The Explainer. Today we're diving deep into Copart's first quarter fiscal 2026 earnings. They dropped their report just after the bell on November 20th, and we're here to unpack it all.
So right off the bat, the headlines were kind of weird. You had a solid beat on profits, which is great, but then a miss on revenue. And the stock? It barely moved. So you gotta ask, what is the real story at Copart right now? Let's figure it out.
Okay, here's how we're going to tackle this. We'll start with that conflicting quarter, then jump into the results snapshot. After that, we'll look at management's long-term view versus the market's short-term focus. Then comes our prediction in the next call, and we'll finish up with the key takeaways. Let's get to it.
So let's talk about Copart's conflicting quarter. It really is a tug of war between profitability and growth. And honestly, this is the whole story in a nutshell. On one side, you've got really impressive execution on the bottom line, but on the other, you've got some seriously weak growth up top, especially when it comes to volume. I mean, this quarter was a classic case of strong margins versus weak volumes. You see this sometimes, right? The company's doing an amazing job with cost control. They've got pricing power, and that's driving up profits. But at the same time, the actual number of cars they're selling, which is, a super critical metric for growth, is falling off a cliff. It's that classic battle, efficiency versus expansion.
Okay, on to the results snapshot. Let's look at the key metrics and see what the numbers actually say.
So first up, the good news. And this is good news for shareholders. Earnings per share came in at 41 cents. That beat what Wall Street was expecting by a penny, and it's up almost 12% from last year. That's a really solid beat on the bottom line, no question. But then you look at the top line, the revenue, and it's a completely different story. $1.16 billion. That's a miss. It came in 20 to 40 million below what analysts were hoping for. And the growth, just 0.7% year over year. I mean, that's basically flat. That's not what you want to see. And here's the why behind that revenue mess. This number really tells you everything. Total global units sold, down 6.7%. And this is where it gets really concerning. Their core business, the U.S. insurance segment, that's their bread and butter, was down a whopping 9.5%. That's a big drop. So this table just lays it all out perfectly. Look at this. On the one hand, you've got a beat on earnings per share and strong net income growth. That's all about great margin control. But then you look at the other side, a miss on revenue and that big, ugly drop in U.S. insurance units. It's the whole story, right there in one chart. Okay, so that's the data. But what did management have to say about it? Let's get into their long-term view. They're basically asking investors to see past all the cyclical noise right now. So on the call, management was pretty upfront about the volume problem. They said, hey, look, we're seeing some cyclical headwinds, things like more people driving without insurance or downgrading their coverage to save a few bucks. But their whole message was, don't get bogged down in that short-term stuff. Look at the massive, long-term structural tailwinds that are pushing our business forward.
And the CEO, Jeff Leo, he really hammered this home. He basically said, look, we believe as much as we ever have that the number of cars being totaled is going to keep going up to 25%, even 30%. And this is the engine of their entire business model. It just makes sense, right? Cars today are packed with sensors, cameras, all this expensive tech. A simple fender bender can cost a fortune to fix, making it way more likely the insurance company just says, forget it, it's a total loss. That trend isn't reversing.
And it wasn't all doom and gloom. They were quick to point out some real bright spots. For example, international buyers are paying almost 40% more for these cars. Their sales to dealers are up over 5%. And other platforms are growing nicely too. And maybe most important of all, they're sitting on a fortress balance sheet. No debt, $6.5 billion in liquidity. That gives them a ton of flexibility. Okay, so that's management's optimistic long-term story. But the market seems to be focused on something else entirely. Let's talk about why investors are so cautious right now.
First, you have to look at the context. This isn't just about one bad quarter. Look at this chart. Over the past year, the S&P 500 is up over 10%. Copart is down 35%. The stock has been getting hammered because investors have been worried about this growth slowdown for a while now.
So why the kind of meh reaction from the stock? Well, think about it. The profit beat was nice, sure, but it couldn't overcome the big issues. Revenue growth is basically zero. Those U.S. insurance unit declines are getting worse. This isn't a new problem. It's just confirmation of a trend we've seen for a few quarters now. So in a weird way, a lot of this bad news was probably already baked into that minus 35% stock price. So you've got these two competing stories. management's long-term optimism versus the market's short-term focus. How do we put it all together? Well, that brings us to the next call, where we give you our prediction.
Our thesis really comes down to three things. One, this is a high-quality company, no doubt about it, but it's dealing with a temporary growth problem. Two, their margins are so strong, it puts a real floor under the business. And three, after falling 35%, the valuation doesn't look so crazy anymore. It seems to reflect the challenges they're facing.
So what's our prediction for next quarter? Honestly, expect more of the same. We think you're going to continue to see those strong margins and great profitability. But we also think that volume weakness is going to stick around. Nothing's really going to change until that insurance cycle starts to turn.
And that leads us to our rating, market perform. What does that mean? It means we think the stock will probably do about as well as the overall market. The company's excellent operations are basically being canceled out by the weak growth. It's a great company, but it's hard to see the stock rocketing higher from here until volumes pick up.
All right, let's wrap this up with the key takeaways and our disclaimer. Here's what this all means for investors.
So what's the bottom line here? It's a battle between a fantastic long-term story and a really tough short-term picture. Management is executing brilliantly on what they can control, like margins, but the market isn't going to get excited again until it sees volume growth come back. So the thing to watch for is any sign that the insurance cycle is finally turning. That's your catalyst. And of course, the final and most important reminder, this is not financial advice.